We are almost at the end of the course and we're almost at the final exam. All right, so jumping back into our next video here, we're looking at 2.4. So this is making financial decisions. So we're going to be looking here at business calculations, so gross and net profit, as well as the average rate of return, also referred to as the ARR. Part of 2.4 was also about understanding business performance. I'm not really showing this in the video. It's really about talking about reviewing graphs and identifying key information. Most things that I've seen from most students while we were covering this content and in the mock exams, most people were doing quite well. It's about recognizing the like bar graphs, pie charts, and things like that, and the bar graphs and so forth. So we're not going to focus on that. This is going to be more of a walkthrough, a few worked examples, and a couple of little practice questions of how we would use some of this information. So starting with 2.4.1, business calculations for gross and net profit. So we're going to jump back to little parts for 1.3. So what is gross profit? So gross profit equals your total sales minus your cost of sales. So gross profit is the profit that a business makes on its trading activity before any indirect costs have been deducted. So remember, when we're talking about the financial statements, your gross profit is the one that comes first, and it's literally taking into consideration of the profit you've made on an item, taking away everything of the actual cost of that sale. All other incidentals like rent, like utilities and all of that, they don't come part of your gross profit, they all come part of your net profit. So your net profit, which is your gross profit minus your other expenses. So net profit, also known as the bottom line, is the profit a business is able to return to shareholders, so the owners, or reinvest back into the business, obviously as retained profits. But your net profit ultimately is when we start to look at, so when we talked about in our early topics of, how do you calculate profit, and that's, total revenue minus like total expenses. That gets back to your same as your net profit. The difference with why we talk about gross and net profit is it's looking at different things in the perspective. So for gross profit, it might be more useful to look at if you're looking at particular sales of goods. You might be looking at the different stocks that you have to work out which are your best, which of your products that you sell that you make the most profit on, most gross profit on. So you can actually look at individual items, whereas your net profit is generally your overall business performance. All right, so let's look at a calculation here. So the following financial information relates to Wilson Limited. So we've got the sales revenue and the cost of sales. So how we would ultimately work that out is take our sales revenue, so 766,200 minus 345,550, which equals 420,650 pounds. So that becomes our gross profit, and that's literally how we calculate gross profit, your revenue minus your cost of sales. So how do we get to our net profit? Well, we now take our gross profit figure and minus all of our other operating expenses. So the 420,650 minus 310,250 leaves us with a net profit of 110,400 pounds. And that is literally how you calculate gross and net profit. So another way that you might see questions structured in an exam, they might give you pieces of information. So you need to start working out what that all actually means, of how you would work that out on an income statement. So if we've got the sales revenue, so how do we know what the sales revenue is? Well, we know that they've told 15, and we know that you can see there that the selling price for a ton of rubbish removal is £200. So literally, you take your £200 times your 15 equals £3,000. And that becomes our sales revenue. So what are our variable costs? Remember, variable costs are the things that differ per item sold. So our fixed costs obviously are the things that are not going to change, like your rent, like, salary, employees and things like that. They're all your fixed costs. So your variable cost is everything that relates to the actual sale of the goods. So if you're not, selling the service of this tons of rubbish here in this example for the waste management, then you're not going to have any of those variable costs. So we know here that there's been 15. So when you look at all the other items that are in there, you've got to make sure that you're identifying what of those are variable. So if you read through there, the cost of disposing a tonne of rubbish and the cost of petrol per journey for each tonne, we can see that there one is £50 and the other is £10. So if you take your 50 plus your 10, which equals 60, so if you take 15 times 60, because we sold 15 units and the variable cost is £60, that leaves us with £900. So then what is our gross profit? So then to get to our gross profit is our sales revenue. In this case, we're minusing our total variable costs. That leaves us now, so 3,000 minus 900 leaves us with £2,100. Now we've got our total fixed costs. So if you look through there at that table, we're talking about there of the £50 per month and the £20 per month, they're our fixed costs. So no matter how many things we sell, we're going to have to pay those per month anyway. That becomes 20 plus 50 equals £70. So our net profit, literally we take 2,100 minus 70 equals £2,030. And that's how we work out our net profit. So it's really about looking at those units and the descriptors that tells us how we should be applying those into our equations. All right, so here's a practice question for you. So you might want to pause the video just to work this out. So calculate the gross profit for the cafe in the table, the 2 mark. Now, once you've done that one, calculate the net profit for the cafe in the table. And this is 4 marks. Why have I made it 4 marks? Because I've actually put in there's 2 figures in that bottom table there for the expenses for you to work out. So we know that calculate questions are worth 2 marks. So if I'm giving you there's 2 things to work out, you get 2 marks for each of those. All right, let's keep going. So once we've looked at gross and net profit, this became a much bigger idea that we started discussing, because obviously that formed lots of what you were looking at in part of your theme 1. We now start to look where 2.4 really focuses in is the gross profit margins. Why do we have the margins? So margins help us compare, because margins will give us a percentage rate. It helps us give information to look at 2 businesses side by side. So if you're working in 2 separate industries, how do you know which one has better margins? You know, if you're just looking at pound signs, if one's £200,000 and one's £2,000, that doesn't actually tell you. It tells you which one has, more cash, but that doesn't necessarily mean that it's working more efficiently. So this is where the margins start to come into play. We start to compare apples with, putting things in the same equation. You might look at, in your own business, you might look at your gross profit margin on the, I talked about how you talk about the gross profit for different products that you're selling. So you might look at the margins for individual products and you kind of go, this might make me a lot of money, but the margin on it is really good. So it's not good, so it's not worth the effort. Whereas something else might be, you might feel like there are bigger margins on it, it might be worth further investment. So this is what it is, because we're looking at the percentages. So you could have a shop and you might sell some accessories and you might sell some items of clothing. But your accessories generally might be, you sell for a lot less, but you might sell more of them. So it starts to looking at, because you're looking at 2 different complete products, you're being able to compare them. So these are your 2 formulas that you need for your margins. So, and they're pretty much the same formula. One is just your gross profit divided by your sales revenue times 100, so you get that percentage rate. And net profit there is the same situation, net profit divided by your sales revenue times 100. So it's quite easy to remember this one. So I've got back to our thing that we looked at earlier. So if we look at our gross profit, so what is our gross profit? So we know there, the 2,100 was our gross profit. If we divide that by our sales revenue, which was the 3,000, and times that by 100, it leaves us with the gross profit margin of 70%. And you can do with that what you will, but this is how you would work out what that percentage rate is. So if now we want to do the same thing for net profit, we take our £2,030 divided by 3,000 times 1,000, and that leaves us with a net profit margin of 67.67%. So it starts to go, well, it's actually quite a profitable business. when you think about overall. So the amount of money that Jeff's making each month versus all of his expenses, it's pretty good, man. It's a good business to be in for waste management. So that's what it can start to paint a bigger picture of the profitability of a company. That's not to be confused with the average rate of return, which we're going to look at separately. All right, so going back, using your answers from the last question that you did, I want you to calculate the gross and net profit margins for the cafe. This is 4 marks for you as well. So because you're calculating the gross profit margin and then the net profit margin. Okay, 2.4.1, so this is business calculations, and we're looking at the average rate of return, so also known as the ARR. All right, so the definition of our average rate of return is that it shows the average annual income generated by an investment. So ARR is used by business to judge whether or not to invest in a new opportunity. So before we look at the formula, when we talk about it, so ARR, think of it as the idea, if you think about something like the Dragon's Den, before someone, so a venture capitalist or a bank or someone like that, maybe bank's probably not a good example, but if you were going to invest in another company and you knew that you were going to invest X amount of money, you want to know how much that business is going to make. So basically, how much return on your investment, no, it's not return on investment, but how much you're likely to see back as a rate to work out whether it's a good investment for your money or not. That's kind of what the ARR is looking at. So there's 2 formulas that come into play with the ARR. So the actual formula for the ARR is the average annual profit divided by your cost of investment and times it by 100. So that's how you're going to get your percentage rate again. But for your average annual profit, you first need to work out what your average annual profit is if you don't have that information. So to work out the average annual profit, you need to take your total profit and divide it by the number of years. So it's actually quite a simple calculation. If you are having to calculate both of them in an exam question, it'd be 4 marks. So you'd be getting 2 marks for each of those. In many cases, they may give you the average annual profit, and then you've got to work out the ARR and go from there. So let's do another work example here. So we've got the formula there at the top, considering investing in a new car for her. All right. So I don't know what happened there. All right, moving back to it. All right, so we've got Michelle Wallace is considering investing a new car for her taxi company. The car will cost £15,000 and will earn profit each year. The predicted profit that it is going to make is £4,000 in the first 2 years, £3,000 and £2,000 in the last year. So the first thing we need to know is the average annual profit. So if we take our total profit divided by the number of years, we are going to reach that by 4,000 plus 4,000 plus 3,000 plus 3,000 plus 2,000 divided. So obviously that is maths. So it's 16 divided by 5. You've got your average annual profit there of £3,200. If we now take our average annual profit divided by the cost of investment and times it by 100. So that's the 3,200 divided by the 15,000 that we're investing times by 100. It gives us an ARR. So the figure of 21. So what does the ARR tell us? Is the higher the ARR, the more attractive the investment opportunity. So if the interest rate from savings is greater than ARR, businesses would rather save their money than invest it. So if hypothetically you worked out the ARR for an investment was about 5%, and let's just say that the economy was going really well and you could get an interest of 6% through a savings account at the bank. you're better off putting your money into that savings account because there's far less risk involved, and it's not such a high return on the investment. If you have an ARR that's like over 50%, that's probably quite a strong one. Probably active. Looking about how high that rate is to work out how good the average rate of return is. So what are some downsides with ARR? So because this is about when people are going to be predicting, it's about working out how much, if they invest some money, what we're looking at here is how much profit they predict to make. So it's hard to predict future profits unless you've got some really concrete data. But even if you don't have that concrete data, that also means you may, even if you've got good information, you've got no guarantees. So this is what we start to look at is, it's hard to predict information about that. Obviously, you could be more conservative in your predictions, but you've still got no guarantees. And it doesn't take account of inflation. So money in the future is worth less than money today. As we talked about 1.5, about what inflation meant, is about how money devalues over time by all the other things happening in the economy. So if you're essentially working something out over the next 15 years, it's really, first of all, that'll be really hard to predict something that far in the future because there's so many things that are changing in the markets. But even in 5 years, there are other things that can happen. You can have other competitors and all of a sudden your profits are a lot less, after a 2-year period, which would absolutely change the whole, would change your decision if you had that information. But we don't know the future. So we look at it to take, to make financial decisions with the information that we have. So just thinking about some of these ideas. Okay. So let's do a practice of these. So I want you to calculate the average annual profit for this day. Just pause the video here. It's 2 months. All right, let's get going. Now, calculate the ARR you invest for 1,000. Again, this is another 2 marks. So pause the video here and let's get going. Now, this has been mostly calculate questions, but I want you to explain one advantage of performing an ARR calculation. This is for 3 marks. Okay. Let's look at the answers and then we're going to wrap this video up. Okay. So to calculate the gross profit table, so we've got 39,000 minus 16,767, which leaves us with the gross profit of £22,233. Now, the next one, to calculate the net profit of the cafe in the table. So we had 2 figures that we needed to work out here. So if we take our 780 plus 12,000 plus 8,700 plus 5,000 equals, so our total expenses were £26,480. And then, so if we wanted to calculate what our net profit was, we take our 22,233, 26,480. We actually got a loss of £4,247. So I expressed the loss in the brackets. If you wrote loss, if you wrote minus, I believe that would be fine for the examiner, but correctly you express that in the brackets as well. Okay. So using answers from the last question, so this was your margin. So we've got 16,767 divided by 22,233 times 100. So that is 75.41% was our gross profit margin. And the net profit margin, as you can see in the equation there, was negative 19.1%. There's no profit and the business is making a loss overall. All right, 50,000 plus 75,000 and divide that by 4. So 750,000 leaves us with 162,500. Of course, this table probably doesn't make sense because why is the profit going up in year 3? And things point is this is just information that's been given. And if you calculate the ARR, if you were going to invest 500,000, obviously figures from before. So we take 162,500, divide that by 500,000 times 100, and that gives us an ARR of 32.5%. So this indicates this investment will get a return of 32.5% each year based on the initial investment of 500,000. So doesn't sound like a bad investment, basically. And explain one advantage of performing an ARR calculation. One advantage of calculating ARR is being able to forecast your return on investment. This is accurately forecasting sales. You can determine how much you would likely see back from your initial investment. Therefore, you can make a better informed decision before investing. All right, that's it from me. This was a short video. The next video, the last one, and you should be all good to go for your exams.